The Bank of Canada has just announced that they're increasing the overnight rate 50 basis points, bringing it up to 4.25%. Is this the end of the rate hike cycle, or is there more to come? Before we get into this video, I ask if you could like, subscribe, and share this video with a family member or friend, as it'll help my channel grow and reach more Canadians who are looking to learn about the mortgage and real estate industry. As I said in the intro, it was just announced that the Bank of Canada is increasing the overnight rate 50 basis points and continuing quantitative tightening, which is pretty much just decreasing the money supply in our economy. Now, banks are also going to be increasing their prime rate to reflect this increase to the overnight rate, bringing the prime rate up to 6.45%. Now, it's important to keep in mind, 6.45 prime rate is not your net rate. To get your net rate, you're going to have to subtract the discount you have locked in for the term of your mortgage by the prime rate. So if your discount is minus 0.9% and the new prime rate is 6.45, your net rate is going to be 5.55. Now, this is the 7th consecutive rate hike by the Bank of Canada in an attempt to cool off the economy and get inflation under control. Some sectors of our economy have already seen pricing starting to drop. For example, the housing market. Rate increases almost have an instant impact on the housing market, as when rates go up, it starts to squeeze out the demand for housing. Since February of 2022, the housing market is down 23%, but other areas of our economy haven't been quite impacted the same as the housing market has been from these rate increases. For example, the price for transportation and groceries are still high, and this is because rate increases impact different sectors of the economy differently. Like I said, how there's an almost instant impact on the housing market when rates start to increase. It may take longer for these rate increases to impact other sectors of our economy, like I said, transportation or groceries. That's because these rate increases need to work their way through the economy, through Canadians' budgets, and start reflecting on the inflation data. It typically takes up to a year for these rate increases, the impact, to start reflecting on the CPI reports. So these 7 past increases haven't even been fully reflected on the inflation numbers that get released out monthly by Statistics Canada. Now, it's predicted that the Bank of Canada's target for the overnight rate was at 4.25%, and they were either going to get there with 2 more 25 basis point increase or 150 basis point increase. And obviously they went with the 50 basis point increase, which got us to that 4.25%. So what's next for the Bank of Canada? It's sounding like hopefully this is the end of the rate hike cycle. I'm thinking that the Bank of Canada is gonna kind of let these rates marinate into the economy and see how the economy is impacted. Currently, the CPI is at 6.9%, which is still way too high and way above the target inflation of 1 to 3%. So hopefully these next coming months, as inflation data comes out, we start to see some of this upward pressure that we've been seeing on inflation decrease and the CPI dropping. It's expected that by the end of 2023, inflation should come down to about 4%. And going into 2024, we should start to see inflation between the 1 to 3% target range. Once we start seeing an ease in inflation, that's when the Bank of Canada should slowly start to bring rates back down. But just make sure you're not expecting pandemic rates. I think central banks have kind of learned their lesson from keeping rates low for a long period of time. But I think you can expect when rates do start coming down that they're in between what they are now and during the pandemic. You know, anything can happen. There could be a big economic event that tightens up the supply chain more, leading to the Bank of Canada increasing rates again. So it's not guaranteed that they won't raise interest rates, but it sounds like this may be the end. One more thing I wanted to point out to support the argument of the Bank of Canada is done increasing rates. So after each rate increase announcement, the Bank of Canada also releases a monetary policy report. Since the first rate hike started till now, all those monetary policy reports ended with this statement, and I'll read it now. Given elevated inflation and inflation expectations, as well as ongoing demand pressure in the economy, the Governing Council expects that the policy interest rate will need to rise further. Future rate increases will be influenced by our assessment of how tight monetary policy is working to slow demand, how supply challenges are resolving, and how inflation expectations are responding. Quantitative tightening is complementing increases in the policy rate, We are resolute in our commitment to restore price stability for Canadians and will continue to take action as required to achieve the 2% inflation target. Now, the past monetary policy report ended like this. Looking ahead, the Governing Council will consider whether the policy interest rate needs to rise further to bring supply and demand back into balance and return inflation to target. Governing Council will continue to assess how tight monetary policy is working to slow demand, how supply challenges are resolving, and how inflation and inflation expectations are responding. Quantitative tightening is complementing increases in the policy rate. We are resolute in our commitment to achieving the 2% inflation target and restoring price stability in Canada. So there's a little bit of difference there where they said the Governing Council expects to raise interest rates to now them saying they'll consider whether or not they'll be raising interest rates. So maybe it's not a lot, but who knows? Only time will tell. I guess we'll just have to find out. Mark your calendars, the next Bank of Canada announcement will be January 21st, 2023, and only time will tell what TIFF has in mind. Finally, my opinion on fixed versus variable rates. I would definitely stay away from 5-year fixed rate mortgages. If we're expected to be at the peak of the rate hike cycle, locking into a 5-year fixed rate mortgage right now wouldn't really make sense. I'd still say variable rate or short-term fixed rate mortgages are the move because you keep that flexibility and avoid that big interest rate differential penalty. If you are feeling the pressure of the increased interest rates this past year, there are variable rate relief programs in place to help you out. Banks can actually let you re-amortize your mortgage up to 40 years to help you increase your cash flow and lower your mortgage payment. Now, for you to take advantage of this program, there are some guidelines you have to meet. I think I'm going to make a video about this next week, but it can be a great way for you to get through this high interest rate environment. If this solution interests you, reach out to me. I have a templated email that you can send to your bank that pretty much just requests the extended amortization. Just shoot me an email at spencer.gray@migroup.ca. I hope this video gave you a better understanding of where our economy was going and update on interest rates. If it did, please like, subscribe, and share this video with a family member or friend. And remember, I also have created those 3 free mortgage guides to help Canadians navigate the housing market. The first one is a first-time homebuyer's guide that includes a homebuyer's checklist. The second one is a refinancing guide. If you're thinking of refinancing, read this first. And the third is you got your offer accepted. Now you need to obtain financing. So those are free. Links in the description below. If you have any questions, please comment them below and I'll be sure to answer all of them. Or if you want to book a one-on-one call with me, my calendar link is below. Go click it, fill out a time slot, and I'll be happy to answer any questions you have.